This is the You Know a Trader podcast, commentary on life as it relates to the markets, finance, and the economy. Nothing within this podcast should be viewed as an investing or trading recommendation. You Know a Trader, Aileron Trading, or any other entities referenced or discussed are not registered investment advisors or should be taken as advisory services. They do not tell or suggest which securities, currencies, or derivatives should be bought or sold. Any speakers or guests of this channel may hold long or short positions within the currencies, derivatives, securities, equities, or industries herein discussed. There is a high degree of risk involved in trading. You Know a Trader, Aileron Trading, or any other entities referenced or discussed are not registered investment advisors or should be taken as advisory services. They do not tell or suggest which securities, currencies, or derivatives should be bought or sold. Any speakers or guests of this channel may hold long or short positions within the currencies, derivatives, securities, equities, or industries herein discussed. There is a high degree of risk involved in trading any financial asset. You should always check with your licensed financial advisor and tax advisor to determine the suitability of any investment. Or you should ask the firm with which you invest, trade, or deal about the specific terms, conditions, tax implications, and risks of any financial instrument and the associated obligations that such trading may place upon you. You should always check with your licensed financial advisor and tax advisor to determine the suitability of any investment. To your individual circumstances, no assumptions should be made in relation to the performance or accuracy of the method shown. No claims are made as to the success or profitability of any statements made.
I am an optimist by nature. I like being optimistic. I think other people enjoy being around an optimist. Conversely, I would also say I don't think people enjoy being around people that are too pessimistic, too full of negativity. We sort of talked about that a bit last week with catastrophe bias and how you can sort of be pessimistic and then all of a sudden you've got a catastrophe bias and then just everything's negative. And I know I've known a few people like that in my life. I'm sure you have known a few people like that in your life. And it's like they suck the joy of life out of the entire room. It's just exhausting. So I say that to say, and again, that's an extreme sort of form of being pessimistic. I like to be an optimist. I'm an optimistic person by nature, as we said. However, being too optimistic can be a problem too. I'll give you a couple of little fluff examples, right? You know, I work a lot and I'm optimistic. And sometimes being optimistic will cause me to come up with some sort of unrealistic deadlines because I'm just being optimistic about it. Oh yeah, I can get that done by that time. I can get XYZ project done by the end of the week. Right? And what is actually happening is I'm being far too optimistic about the timeline. I've had business partners actually look at me and it's like, oh, okay. There goes the optimist again. So more realistically, like by the end of the month, right? And can we see it by the end of the month? And it's not that I'm not going to work on it. As a matter of fact, my wife, to her chagrin, sometimes I feel like, she's like, you need to rest more. You just work way too much. So it's not that I'm not working at it. It's just, I'm just too optimistic about the timeline. I enjoy work. All right. I'm a little bit of a weirdo. I like to describe myself, and I say this with a laugh, but a little bit of a psycho, right? I'm the guy that's involved in 7 different ventures? I guess you could say 8. It depends on how you count them, but I'm either the junior partner or the senior partner in 7 different companies, a trustee. It's like, I love to work. But sometimes when it comes to creating a deadline, I'm a little too optimistic. And, there's other sort of smaller problems that can come along from being too optimistic. Like I take on too much, right? How do you think it came about that I'm the junior or senior partner in 7 different companies and a trustee? It's because I like to take on projects. I like the projects that I take on. I'm optimistic. Oh yeah, I can get that done. And, oh, wow, look at that. I've got a lot on my plate. So we say all of the proceedings simply to say, I think people like optimists, but just like being pessimistic, and sometimes pessimists are great because sometimes a pessimist is a realist. They're just being very realistic about things, right? But that can get pushed too far, as we discussed in podcast number 2, the doom porn arbitrage trade. Basically, optimism can get pushed in the wrong direction, and it can have a really, really, really bad effect on your finances. So let's talk about that a bit this week in this particular podcast. And it's sort of like we were saying, we talked about catastrophe bias. We talked about doom porn in podcast number 2. We talked about the doom porn arbitrage trade. Side tangent, small one. I think I may have geeked out just a little too much with the trader talk. But I was trying to, if I'm going to call it a doom porn arbitrage trade, right? I have to describe what an arbitrage trade is, because this podcast is sort of created for folks that maybe have dabbled in trading. It's like, I call it like diet trading podcast. We don't get too heavy or too specific in this podcast. But all of a sudden I found myself talking about complex spreads and delta neutral option strategies. And it's like, all right, maybe I pushed that envelope a little too far last week. So we're going to try this week, and I'm making a conscious effort this week to sort of pull it back a bit and not geek out too much with the trader talk, right? That being said, as we were saying last week, we talked about the doom porn arbitrage trade in podcast number 2. Well, this is just sort of the flip side of that coin. It's optimism pushed way too far. And it can result in a couple of problems. And we're going to talk about those. Normalcy bias and avoidance behavior. So normalcy bias, avoidance behaviors are sort of the flip side of the same coin of catastrophe bias and doom porn. Okay? So let's just define them first of all. These are all, and these would all fall under the umbrella of a cognitive bias. So I guess we have to talk about what a cognitive bias is. We've been talking about them for, what is this, the second week now that we're talking about them. So maybe we should even back up just a little bit further and define what a cognitive bias is. It's sort of like a magnet in your brain towards faulty thinking and irrational decision making. Does that make sense? It's like you get a compass, right, that points true north, or points north, I should say, to magnetic north. Well, if you put a magnet near that compass, then your compass isn't very good, is it? It's not worth anything. Well, that's sort of the way to think about a cognitive bias. You have rational decision making, and it's like sort of a cognitive bias is like putting a magnet right next to that compass of rational decision making. You're not making decisions in a logical manner because of some bias that you have, that bias being sort of like the magnet, a cognitive bias. So that being said, let's talk about normalcy bias first. We're going to define normalcy bias, and we're going to define avoidance behavior with a few examples. Okay. As we were saying, it's great to be an optimist. I like being an optimist. I like associating with other optimists. And I don't think being an optimist is simply being naive. It's not about being naive. As a matter of fact, just real briefly on that topic, I know in my own case, it's not about being naive to the world's dangers and the world's evil. I have seen plenty of it. Plenty of it. I spent my first night on my own, completely on my own, in the wintertime at 16 years of age. And it being wintertime, I was spending the night in a car. And the car had these rusted, holes in the floorboard. So I was literally, to stay warm, I was taking newspaper and stuffing them in the holes of my car that, where the rust had created this hole in the floorboard. I called that car Scooter, right? Because it's almost like you could almost put your feet through the rusted floorboards and sort of scoot yourself along. So I called it Scooter. And yeah, my first night on my own at 16 years of age, stuffing newspapers in the middle of the winter to stay warm. I'm not naive when it comes to the dangers of the world. I've seen my fair share of it. I lost transportation. I was completely and totally on my own at 18 years of age, and I had no transportation at 19 years of age, so I was sort of stuck. So I say the proceeding simply to say that my optimism is not born out of being naive. I have lived abroad, and I've seen some pretty evil and pretty graphic stuff. So sort of being an optimist is sort of, I don't know, you want to call it my hope, sort of my tether. That phrase, it'll be all right in the end. It sort of saved my sanity at times from some pretty horrendous situations. I sat there and actively reminded myself, it's not going to be this way forever. And I think at least that's where some of my optimism comes from, is just being in horrendous situations, not being naive to the world's problems, and reminding myself it's going to be all right in the end. This situation, wherever I'm at, this isn't my whole life. There's going to be a tomorrow, and there's going to be a day after that. So I like being an optimist, right? I think it saved me and saved my thinking processes in some pretty horrendous situations. So it's not born out of necessarily, sometimes it is, but it's not necessarily born out of just being naive. Okay? But let's talk about normalcy bias and exactly what is normalcy bias as a cognitive problem. Well, it's what it sounds like. You just think everything's going to continue normal because of some bias that you have, and you are very slow to react to real risk and real danger that comes up. Someone with normalcy bias does not prepare for problems very well. They do not prepare for risk very well. And sometimes it becomes this like rainbow and sunshine and bunny rabbits and daisies and unicorns sort of look at life. And look at problems. Oh, it'll be all right. Just sunshine and rainbows, that sort of thing. And it causes one to be very, very slow to adjust to problems. And that's especially dangerous in emergency situations and disasters. I saw a study one time that said that over 80% of people, when they are in an emergency disaster scenario, display all the signs and symptoms of normalcy bias. They are way, way too slow to react to the danger that is right in front of them because they've never thought about that danger. They've never prepared for that danger. They've never analyzed what would I do in that particular danger. It's just this incredible slowness to react to risk because they just don't want to think about it. And we'll get to the don't want to think about it in a second. Or they just simply don't entertain the thought. Well, I don't want to think about that. That's unpleasant. So I'm not going to consider that. Well, I think you should, because sometimes unpleasantness comes your way. And what can happen, what can assist you is when you have thought about it ahead of time, you have thought, okay, how am I going to work my way through that problem? Okay, and then when that actual issue comes around, it's like, oh yeah, I remember this thinking pattern. I remember I said I was going to do this. Well, people with normalcy bias, it's just, no, it'll all stay normal. Oh, that won't happen. Oh, why think about that? That's too negative, right? You're dealing with somebody with normalcy bias. Give you a couple examples of normalcy bias. One from my own life. I was with some folks. I love them dearly. No reason to name names. But we were driving home in a storm. And it was a bad one. It was in the Midwest, and it was a pretty bad storm. And we turn on the radio to hear what's going on because the storm is that bad. Like, a storm is bad when it's like, turn on the AM radio and see what we can find out about this thing. Okay, if you're even asking that question, it's a bad storm, right? And we're trying to make our way home. And the radio reports there's tornadoes in the area. I didn't see any, but totally believable from just how bad the storm was. It's like, okay, we've had sightings of tornadoes. Tornadoes have touched down in the area. Find shelter quickly. And so that's what we were doing, trying to make our way home. and we weren't too far away. So I'm driving, and it's through some subdivision streets, right? And the people with me, I could determine. Have you ever been in this situation? I could determine pretty quickly they'd never thought their way through or been in many disaster or emergency situations. Matter of fact, one of the people who was present at that time said, if there's an emergency, I can tell you this right now, you want Dan in your corner. You want Dan there. And so debris is hitting the window, and it's just raining bad, and the wind's just like, you can feel it rocking the whole car, right? Well, we turn this corner, and one of the utility poles, one of the utility poles had been knocked down into the street, and there's live wire sparking, right? So there's snap, 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 right? The wires are in the street. The street is wet, and that live wire is just popping off right in the middle of the street. So I thought, okay, well, put the brakes on. We can't go that way. And we were almost home. I would say we were probably within 300 yards of home. And it's like, okay, I can't get home this way. And I'm instantly thinking about, okay, well, what I can do is I can back up, go down that street, loop around, come in the opposite way. But when I put the brakes on and they saw that live wire just snap, snap, snap in the middle of the street, they lost their stinking minds. I mean, flipped out. And I just thought, okay, they've never been in an emergency situation. Just ignore them. Do what you got to do to get them home. And they started grabbing me. What are you doing? What are we doing? We got to get home. We got to get home. And I'm they were grabbing me to the extent it was distracting me from what I had to do. Right? Well, why were they reacting that way? Normalcy bias, a slowness to react, poor decision-making, irrational decision-making. Yeah, I'm going to grab the guy that's driving, trying to get us home, who's acting sort of calm. It was normalcy bias. They hadn't thought through emergency situations and what they're going to do and how to calm themselves and how to keep themselves calm to just work the problem. These are all skills, by the way, that if you ever decide you want to be a financial trader, these are all skills that you have to have. So that's just one example, right? And I just looked over and was like, oh man, these folks have normalcy bias in a bad way. We did eventually get home. Another historical example of normalcy bias everyone's aware of, look at the Titanic. Hits the iceberg, they send the ship's carpenter down, and pretty obvious, not only is water coming in, but it's going over the bulkheads. And it didn't take them long to figure out, yeah, we're in serious trouble. We got to put people off on the lifeboats. Actually, I know a lot about shipwrecks and just a history of them, not just the Titanic, but many, many shipwrecks. You want to ever, by the way, side tangent, you ever want to read about an absolute nightmare, the likes of which will give you chills at night and some people are attracted to that, right? It's that's so scary, I don't even want to think about it anymore. Look up the history of the Daniel J. Morrell. Take a look into that shipwreck. It's beyond creepy. Anyway, look at the Titanic, right? I know a lot about shipwrecks. And once they had decided, we got to put people off on the lifeboats. And we're going down fast and water's going over more and more bulkheads. We got to get off this ship. People wouldn't do it. First few lifeboats went off, half filled. Some of them weren't even half filled. Why? Normalcy bias. Oh, it's not going to be that bad. A slowness in making a decision. Some people have called that, especially in financial markets, analysis paralysis. Very slow when it comes to an emergency. And when it comes to risk, thinking through the scenario and making a rational decision and what they would do because they haven't trained themselves to be decisive with the facts at hand. And evaluating the risk, let's look at the risk first. So it's sort of, as we were saying at the outset, the complete polar opposite of catastrophe bias. Now, that's just the definition of normalcy bias. We're going to come back to it. But there's also avoidance behavior. Avoidance behavior is take normalcy bias and just keep pushing it, right? You'll get people with avoidance behavior. There's many forms of avoidance behavior, but just take normalcy bias and just push it to an extreme. And cognitive avoidance is just, you're not going to think about anything that you don't want to think about. And, there may be a risk that's rising in your life, and I'm just not going to think about it. Well, this is a problem, and it's really coming about. Well, I just don't want to think about it. But it's thinking about you because it's staring you in the face. You need to think about this, and you need to deal with it. Oh, I'm going to go do this. You ever known anybody like that? People with avoidance behavior problems, they'll avoid the easiest solution, the easiest fixes to a problem because they're just stuck in, I just don't want to think about anything other than what I find comfort in. Folks who are just avoiding things, generally there's something else in the background, and easy solutions. $1.50 a week, right? Just save up $1.50 a week, set it aside, go get your oil changed. Nope. And eventually, what you've been avoiding comes a knocking, right? And your engine seizes up, and you're 19 years old, and you ain't got nowhere to go, and you ain't got any transportation. I knew an older gentleman like that one time. Worst case of avoidance behavior I have ever seen in my life. Love the man dearly, but my God, avoided the most simple, routine things like changing your oil or just any simple routine matter you got to take care of in your life because they just, and I know in that case and in other cases, generally it's born out of some sort of trauma. It is. Excuse me. I mean, he was an older gentleman, right? But again, it was the same thing. He wasn't an 18-year-old kid. He was much, much older. Wouldn't change the oil in his car, wouldn't get his driver's license renewed, wouldn't get his registration done, just avoided everything. He since passed away. So it can become very, very, very serious. Just people with problems and they just avoid everything. So that is normalcy bias we defined. We sort of got into avoidance behaviors. I think everybody maybe has known somebody with some avoidance behavior problems. So that sort of just lays out the definitions for us, right? Now and again, I think you can see quite obviously, this is the flip side of the sort of catastrophe bias. Everything's going to be horrible. It's the flip side of that. It's the flip side of the catastrophe bias and the doom porn arbitrage trade, right? It's the normalcy sunshine and rainbows bias trap. Regardless, the first part of this podcast, that's what we've been talking about, right, is behaviors and how it can affect your money. And it's all based and wrapped around that normalcy bias trap. Just everything's going to continue on as normal. I don't have to think about that. I don't have to think about unpleasantries. That's just unpleasant thoughts and that's being negative. And we don't want to think about that. And that's a normalcy bias trap. It's a well-known academic cognitive bias. And it leads to bad outcomes. Very, very bad outcomes. Okay, now from that, I want to switch gears here for a second. Okay, so we're going to switch for the last part of this podcast into talking about something that relates to normalcy bias, something that relates to this entire concept of just sunshine and rainbows and it'll always be okay. And make it a little more finance related and trading related. And it is the entire concept of passive investing, being a passive investor. All right, so let's just start with where I come out. I am a financial trader. I trade. I short-term trade. Now, I also am the senior partner in a private proprietary firm, and we run something that's referred to as multi-strat or multiple strategies. It gives you a more smoothed out return, something referred to as higher Sharpe ratios. We aim actually for better Sortino ratios is our whole goal. And I just say that to say that we have many strategies that we run simultaneously for the aforementioned reasons, right? But some of those strategies, some of those trading programs that we run are longer term. I have one particular, and I refer to it as a trading program. I don't believe in this whole investing versus trading thing. I don't think that's real. Everything you do in your life is a trade. You become a financial trader, you find that out real quickly. You know the old line, you see the way broadly, you see it in all things. Once you get to know trading, I mean intimately familiar with financial trading, you begin to see it everywhere in life. And therefore, I don't believe there's this thing as like, this is investing and this is trading. There's just periodicities. If I buy IBM in 2012, take all the dividends, have a synthetic reinvestment of those dividends, hold it continuously, it's still just a trade. I have given up my cash for IBM. I've made a trade. Well, it lasted so long that don't you believe yourself as an investor, and you're looking at all of their company ratios and how the company's doing and what's the company doing, and you listen to so that makes you an investor. No, it doesn't. We're all traders. Even if you're not in financial markets, you trade your time. You make decisions about where you'll work. That work comes with a risk and a reward ratio. Benefits and drawbacks. You made a trade.
Excuse me. You made a trade. I am a firm believer in that, and there's a lot more to that particular belief. Listen, don't come at me. I understand the vulgate understanding of the terminology. I've been doing this for nearly 30 years. Yes, I understand anything longer term is supposed to be investing. Anything shorter term is supposed to be trading. But why do you repeat that? Because you heard it from someone else? I'm being serious here. Why do you keep repeating, well, investing is longer term and trading is shorter term? Why do you keep repeating that? It's a question I think people need to ask themselves. And listen, I'm just coming at it from the standpoint of a trade is a trade. Is a trade is a trade. Listen, you exchange value for what you perceive as value. You give up dollars for something that you perceive will gain in value. You give up your time. Value for perceived greater value. Or dumping value because you believe it's going to lose value. Value for value. Everything's based on value. I don't care if you're short-term tick scalping in interest rate futures. I don't care. That's value for value. And it's the same to me as if you're holding IBM since 2012 and still holding it. Value for value. Everything's a trade. And yes, I understand. I'm not so arrogant as to believe that I can change the vulgate understanding in finance of, what is an investment and what is a trade. I'm not so arrogant as to believe that. But I'm also a student of linguistics. So
I think we're all financial traders. So that's sort of where I come out. I'm just going to let you know that ahead of time. Now, that being said, there is this entire argument for being a passive investor, which I don't really believe there is such a thing. You're just a trader in a longer periodicity. And generally the belief is buy the SPY or buy the Diamonds DIA or buy the QQQ as an ETF, an index exchange traded fund, and just hold it. And then when it dips, buy more. And then when it dips, buy more. And then when it dips, buy more. Now, at this point, you're probably thinking that I'm going to argue against passive investors. Oh, here comes the financial trader, and he's going to tell us why being a passive investor is wrong. Well, first of all, again, I don't believe there is such a thing as being a passive investor. I will use that term because the world uses it. I'm not so egotistical as to think that I can redefine, the way human beings communicate. But fine, let's call it passive investing. If you think I'm here to tell you to stop doing that, you're wrong. I'm not going to argue against you being a passive investor. Not at all. As a matter of fact, I am a professional trader. And I can tell you this, our nemesis, the folks that we're trying to beat, the arguments that we're trying to overcome are always against just passive investing. Well, why not just buy the VIGRX as a mutual fund and just hold that? Dave Ramsey tells people to do that. Listen, if you think I am here to say don't listen to that advice, you're wrong. I would also consider myself a quantitative trader. Actually, our approach is we run multi-strat, as I've already mentioned, quantitative programs along with systematic discretionary programs in addition. So I say the preceding. I say that to say, if you think like I believe all of my trading programs are the single greatest trading programs, and you should listen to me, again, you're wrong. Patrick Boyle had an excellent piece. He's also a quant. And he had an excellent piece on what is quantitative trading. And I'm not sure if it was an interview or what. I highly suggest you go look it up. And I was like, man, Patrick nailed it. And I mean nailed it. His whole point was, if you think we've got these programs and I always know that this will always work, you're wrong. I don't believe my best performing programs. We've got programs right now that are they're killer. And I don't believe any of it. I have a good friend of mine who is a financial trader, and I love the way he put it. I am strategy agnostic. So we say all of the preceding to say, I don't believe in anything. To be a really good financial trader and to be a good quant, I think you shouldn't believe in anything. I mean, you need to be highly cynical. Because when you start true robustness testing of any financial trading program, you find out real quick your great idea maybe wasn't so hot. Just may not have been the greatest idea when it's actually, put through its paces. So we say all of that preceding to make that point. If you think that I'm here to just poo-poo on passive investors, no, because everything works and everything doesn't work. That's the way I've put it. It depends on your risk model. It depends on the unfolding future. When we robust test a program, you put it through its paces. What if that drawdown was twice as bad? What if it didn't turn around? What about this? What about that, right? And you learn that, well, I'll just put it this way. I'm a firm believer in multi-strat. If you really want the holy grail of trading, it's been called that. And this is sort of our speciality over at GTC Traders, the other company's brand, the other brand that I'm a part of. It's multi-strat. I'm not the only one that says that. Ray Dalio has literally a YouTube video called The Holy Grail of Investing, and he's basically covering multi-strat. There's been papers written on how many trading programs is too many to capital efficiency and all of that sort of stuff. I'm not going to bore you with that here. But the point is, I'm not going to try and argue you away from being, a passive investor. Stop doing that. You should become a financial trader. I think all of those arguments on the internet are just sort of stupid. I really do. There's nuance to life. And people who get involved in these, what's better? Is this better or that better? There's so many nuances to all of these questions that I think anybody that gets involved in this, what's best, is just stupid. Plus, I don't know other people's situations. I don't know what, their life circumstances is. Very obviously, not everybody can be a financial trader. That's one area where I so wholeheartedly disagree with Tom Sofisnoff and gang. I think they've got great products. I sing their praises on customer service. Best customer service you'll ever have is from Tom and Scott over at Tasty Trade, by far. But not everybody's going to be a financial trader. Flat out. Like, people just don't have the time. I know the people that have learned it, and it's like, this isn't my gig. I'd rather somebody else do it. That's why we have specialized skills throughout any economy, right? So I think it's really good to learn the skill of trading, and I think that's something that assists it. I would agree with Tom Sosnoff there. But the idea that everybody's going to become a financial trader, no, they're not. And they probably shouldn't. We need welders, right? We need people who build houses. We need people who pour concrete. Like, not everybody can be a financial trader, nor should they. So regardless of any of that, big long Otello, as I do, sort of my big long disclaimer, I'm not trying to argue you out of being a passive investor. It is a viable approach. I myself have long-term programs that last years. I will say this, bringing it back to the topic at hand, you really need to be careful of dangerous assumptions. I've seen ones who are like disbelievers. Maybe disbelievers is the wrong word, disbelievers in drawdown, but it's like just people who ignore drawdown I've seen out of this passive crowd. There's this guy on Twitter. I won't name him. I don't want to bully or gang him, but he's a passive guy, like Perma Bull or something like that, or Bear. I don't know what it is. I can't even remember his name. Regardless, he's there's no such thing as short-term trading. It's a mistake. Don't ever get involved with it. It's a scam. Nobody's a day trader. And then his own drawdown, he just completely ignores when the market's in drawdown. That is dangerous. If you want to be a passive investor, fine, awesome. Matter of fact, I think you really, and I think the point of what I'm about to say here is you really need to learn a longer-term hedging strategy so as not to ignore drawdown. But there are those folks out there like him, and it's just, and I'm going to use the word again because it's the only word I can really think of when there's so many objective facts to contradict it. It's stupid. It's just stupid. Because guys like that, and if I've seen one of them, I've seen 1,000 of them, will say things like, day trading's a scam. There are no successful day traders. There are no successful short-term traders. It's all a scam. Nobody can do it. That's why the only thing to do is passive investing. Now, there's one response to that. You're stupid. Sorry, I'm blunt, but you're stupid. There's so many objective ways to disprove those statements, it's ridiculous. There are databases filled. Barclay Hedge. It used to be Altegris, now CoQuest. I don't even know what they're calling themselves. IASG. There are databases filled, and I mean filled. Just list after list after list after list after list of audited third-party short-term traders. And that's just number one. That's before we get into the entire industry. Open prop, I think, has devolved into a scam for reasons that GTC traders mentioned. We actually had a piece on that. The fee arbitrage on the dream of being a trader over at GTC Traders. You can look that up. So open prop, I think, is a scam. But there's an entire closed private prop industry of just closed partners that get some wealth together and you trade it. Guess what? I've got one of those firms, folks, right? There is an entire industry there that contradicts those silly statements of people who do successfully short-term trade. And all it is a little psychological defense mechanism. That's all it is. It's like, well, nobody short-term trades. It's all a scam. Well, you're stupid. Sorry. There's so many objective realities and ways to disprove the concept that it's a scam. It's mind-numbingly silly. So, having said that, I will say that there is a segment of passive investors that they ignore drawdown. In other words, when the market starts sinking against them. And the idea that you're going to ignore it, that's dangerous. That's falling into a normalcy trap that it'll always be this way. What is normalcy bias? A bias towards everything staying normal. Sunshine and rainbows. It'll always recover. That's a pretty big assumption. You are playing a dangerous, I would call it THETA assumption game that you can play and that it will recover. Your normalcy bias is it will always stay like this. Over at GTC Traders, we did a link. I'm looking at my notes. We did a link. I'll give you a link. We did a research piece, right? And I'm going to put it in the description of this particular podcast. Matter of fact, I'm making myself a note to do that right now. Link to long flat. So it's a educational piece. It's a research piece that we did, sort of quantitative research piece. It's not meant to be a quantitative trading program. That's not the point of it. The point of it is to teach and illustrate a point. So I will link it, long flat in description. Just making myself a little note here. How much better you can do as a passive investor if you understand the danger of drawdown and that maybe there's some times where you want to get flat. And how much better you can do over time, realizing that going to cash and staying flat for, let's just say, 30 days under certain circumstances is the right move. Now, you're not going to see it show up on short-term time frames. As a matter of fact, if you apply the research in that piece, you'll see there are time periods like 2015 where the market outperforms you. Right? You get chopped up because of the type of market that you had, that congestion that we had in 2015. I think it led into 2016 as well. But over time, that long flat will destroy the S&P 500 index. So this idea that nobody can beat the S&P 500 index is demonstrably false. Bill Dunn's program's done it. It's been doing it since 1977. So again, that's another argument you'll hear out of, you want to be a passive investor? Fine. Great. I'm not telling you not to. But this idea that nobody can beat the S&P 500 index, and I'm sorry, but Dave Ramsey is one of the guys who I think, could be wrong, Dave can correct me if I'm wrong if he ever hears this, I think is one of the guys that have said that. Nobody can beat the S&P 500 index over a long time period. Wrong. Many people have done that. Bill Dunn's been doing it since 1977. Now, Bill has a lot of volatility to his program, but I don't think really that should scare anybody that's a passive investor. You guys live on drawdown, right? So my point here is don't ignore drawdown. Don't get trapped into a normalcy bias. Everything's going to be sunshine and rainbows. It will always recover. That's a pretty dangerous theta assumption game you're playing. And listen, if you don't want to look at the link, the long flat that shows, yes, over time you can destroy the S&P 500 index. If you don't want to go look at Bill Dunn's program that's been running, I think, since 1977. I think Bill's retired now, and I think maybe his son or other folks are doing it, that has destroyed the S&P 500 index. If you don't want to go look at that, fine. But understand this. You are staking your investment future on an assumption. Lost decades in the S&P 500 index have happened. Do you, and I don't know your life situation, but do you have that amount of time? See, in options, we have something called theta decay, right? In other words, time decay. It's a hourglass of time that's just running out on you. And it's a factor that option traders use to their benefit. They sell options. They literally, quite literally, sell time. And they do quite well with that because time evaporates away and all the other parts of the differential equation as far as, Black-Scholes, as far as option pricing, and you make money. Of course, there's real risks with that, doing that as well. But what we're saying is you're sort of doing the same thing with your investing future. If you get into this sunshine and rainbows and unicorns, normalcy bias trap of ignoring drawdown. You want to be a passive investor? Fine. I think you might want to look at that research piece. Just saying. Okay. Now, I want to start to tie all of these ideas together. Okay? A cognitive bias that we mentioned at the outset is just some bias you have in your thinking, some fault in your rational decision-making process that is like setting a magnet next to a compass. It's tilting your intelligent decision-making away from true north. A cognitive bias does that with your decision-making. And in the previous podcast, we had discussed there is a cognitive bias towards catastrophe. There's actually many, many, many cognitive biases. But there is something that is known as catastrophe bias. Those people that are just always negative, always looking for the catastrophe. Everything's going to crash. Everything's going to be horrible. Generally, in the rest of their life, they're the sort of individual, when you walk into a room and they start talking, they just suck the life straight out of you. They just have this ability to just suck the joy out of life. Well, another cognitive bias that we discussed at the outset is normalcy bias. It's the complete opposite of that. Everything's going to be fine. Everything's going to stay as it is. Nothing's going to change. And that really builds a slowness to react and ignores real problems. What we espouse at GTC Traders is a byline I have used for a long, long time. Reason, rationality, balance. Be Mr. Spock. As much as it is possible for a human to be Mr. Spock, be Mr. Spock. Try to eliminate all your cognitive biases, all your biases, period, out of any decisions when it comes to money or investments. So, moving forward a little bit, we mentioned that normalcy bias, I think, tends to impact passive investors, if we want to use that term. It tends to impact them more. What I have noticed is that there seems to be such a defense to the idea of passive investing, which as I said before, I don't get. You want to be a passive investor? Great, fine, wonderful, go with God. But there's such a defense and so much of this stupid back and forth active versus passive, which is stupid, by the way, on both sides. Stupid on both sides. But since there is that argument back and forth about passive versus active, then those on the passive side tend to adopt arguments to defend their position, right? Okay, fine, wonderful. Everybody does that with whatever position they particularly hold. But some of those ideas are false, and they are demonstrably false. No one except the elite few like Buffett beat the S&P 500 index. I'm not even going to go near what you mean by beat the S&P 500 index, but let's just talk about it in terms of just alpha, just pure alpha, okay? Just beating in percentile terms the S&P 500 index. Well, if that's what you mean by that, you're wrong. And I don't mean there's 3 or 4 databases. I mean there's scores and scores and scores of databases filled with professional money managers who are audited. So this is not like some guy says, I got a cousin who, I know a guy. No. Look at this website, and I'm saying a guy with an educational coaching, mentoring website in one of his other companies for traders. No, none of that stuff. This is regulated. It's overseen by the federal government. You have to produce papers for audits once a year, once every 2 years for oversight committees of the government. And these databases are filled with individuals who, quote unquote, beat the S&P 500 index. Now, that false idea of only the elite few like Dalio or Buffett or maybe a couple of other names can, quote unquote, beat the S&P 500 index, being false, reinforces that whole normalcy bias. It reinforces. It's like, I don't have to do anything because, and this is really key because I just see this to an incredible degree. It seems like everybody just leans back and says, this is why it's okay for me to not do any more digging. This is why it's okay for me not to learn a little bit more as to what's going on. This is why it's okay not to go look at that link that Dan provided that's a free article that you can read for yourself. There's no sign up or anything. Just read it on long flat. Sometimes you don't want to put something in the middle. That educational piece, I don't have to read that, right? That shows the complete destruction of S&P 500 index terms. I don't have it. It reinforces a belief that you can be lazy. It reinforces, to my mind, normalcy bias. Everything's just sunshine and rainbows. I am not arguing, trust you me, as an active trader, I am not arguing against the specialization of labor, and that some people excel in a certain field, and that's what they market themselves for. That's what money managers do, right? I'm by no means arguing against that. Some people, it's like, yeah, I want to run this business, and I'm taking some of the business and I'm investing it, and I'm doing so with these 3 guys, right? Or these 4 different entities. I'm going to swing back to that last sentence I just said here in just a second. So they don't look any more into it. Whereas if they would learn just like 3 or 4 little key concepts, they could still remain a passive investor and do better. Because, as I said before, we're all running out of time. Every last one of us. In the world we got right now, every one of us is going to die. With the world as it exists. So we've been on a great bull run in stocks, right? Wonderful tear. And it feels good. Feelings and emotions tend to influence cognitive biases as well. I try to divorce, if you want, divorce emotion completely out of it. You want a friend, get a dog. But long periods of drawdown do happen, and at some point in the future, I can guarantee you this, they will happen again. In the history of the S&P 500 index, we have had drawdown periods of 25 years before a new high was made. Well, there's things you can do in the middle of that 25 years. True. I'm one of the guys that espouse that. However, if you've fallen victim to normalcy bias, that things are always going to stay normal, and if you're adopting false beliefs in your argument, then you're going to be what? What does normalcy bias lead to? It leads to slower decision making, right? You're slower to react. So are you really going to take advantage of those things that you can do in a 25-year period? 1929 to 1954. 25 years where the S&P 500 did not make a brand new high. Active traders will be doing things during that time to take advantage of dips and drawdowns and this and that, right? But if you have normalcy bias, you're somewhat subject to the whims and the change of emotion. And you do things when you should not do them. And when it comes to 25 years worth of time, my simple question to you is, do you have that much time left? Excuse me, I cannot get rid of this cough. But yes, my simple question to you is, do you have that much time left? What if the market goes into a period of drawdown and it lasts for some amount of time? Now, let me illustrate this. Some of you folks who were around during my first iteration of doing this, that was some time ago, right? Well, time has passed, and if you can believe it, those of you who knew me back then to where I am today, how old I am. Now, if we went into some 25-year period of drawdown, let's say, which the S&P 500 index has done before, it's at certain points. I was talking with somebody, and they asked me, this was during a period of drawdown, they asked me, hey, how far do you think the market can fall? And I says, well, to my mind, I was saying recent history, 75%. It could lose 75% of their value. And they literally looked at me and said, that's impossible. That's never happened before. And I just thought, wow, I am old. Wow, I'm old. 2000 is that much of a distant memory. But yeah, I mean, look at the Qs during 2000. That index lost 75% of its value. But anyways, let's rewind here a little bit. As I was saying, if you take during that first iteration on YouTube and the internet and what was there was the blog, there was no nonsense trading and sharp trading, all of that, right? To where I am now and how old I am. In 25 years, I'll be staring at 80 years of age. So again, my question is, do you have 25 years? Because many people don't. And this is also why the very simplistic answer of just average down, man, just average down, man, just average down, man, you may not have that much theta. You may not have that much time left in your life. Oh, wait a minute, Dan. This is starting to sound a little bit like that doomsday porn you were talking about in the very previous podcast to this one. It's starting to sound a little bit like catastrophe bias. Not by any means. What you do when you develop a trading program is you ask, but what if? What if? And remember what we said about avoiding normalcy bias? How do you avoid normalcy bias? Right? And what happens during normalcy bias? What happens is there is a slowness to react. So you know how you get rid of that slowness to react to where you just sit there with your eyes blinking and not knowing what to do? Well, I'm not sure how many of you like to listen to Jocko's podcast. Personally, I am a fan of Jocko Willink's podcast. Something they do in the military, right? What do they do in the military? Drill. They look at, okay, well, what could we do in this scenario? Let's invent a crazy scenario. What could we do in that scenario? Okay, well, what would we do? Well, let me throw some kink into what would normally happen here and just see how good you get at adapting and reacting and making decisions. Well, wait a minute, Dan. Are you now telling passive investors that they have to be active traders like yourself? No, I am not. I'm going to go over a few things here as we finish up this podcast that you can start to think about if you just want to remain a passive investor your whole life, to where you don't have to worry as much about a 25-year period because you would know what to do. And maybe not even you would know what to do. You've already done it. You don't have to worry about it. You don't have to think, oh my goodness, well, I'm just going to hope and pray that doesn't happen. Oh, that won't happen. Sunshines and rainbows and unicorns, everything's going to stay normal and it's just going to go straight up forever. Let's not think about that. That's bad. No, let's think about it. And I'm not saying you have to become an active trader, okay? There are several things you can do as even a passive person to avoid some sort of eventuality where you're screwed and you're just averaging down forever and then you run out. There's something called systemic risk and tail risk. And that's basically, if I'm going to make this very simple in like 45 seconds, one thing goes wrong, and because that thing goes wrong, then another thing goes wrong, and that starts a chain reaction, and you never planned for this, so now this other thing goes wrong because the second thing went wrong, and you are in a world of hurt. It's referred to as fat tails, tail risk, and let me tell you something. That happens in life. And you can easily, and I'm not talking about market returns, I'm talking about life. Life is difficult and life is tough. And sometimes the challenges of life come in series. So what can you do? What can you do and remain a passive investor? Well, first of all, we mentioned that educational quantitative research piece that GTC Traders put out. The link's going to be in there. Just doing that dumb, stupid thing. You don't have to worry about the periods of drawdown as much. B, you already experienced a drawdown that many of us do not consider acceptable if you're a passive investor. People will be down, it's down 15%, buy more, which is actually a viable trading strategy. But, it's down 35%, buy more. Oh, it's down 40%. That's happened. Buy more, right? Which is viable. But it takes so long. So, if you want to cut that time, I would say, number one, look at that research piece that we did. It's over at GTC Traders. The link is in the description to this particular entry. And it takes that, let's say, 25-year period and just shrinks it. And you're not losing. You're not down. And so if you're adding capital to this as a passive investor, you are not down during that time period. And if you don't think passive investors can do this, I know a guy from high school got a hold of me. He's like, "Hey Dan, you're XYZ. I heard through the grapevine you're doing this for a living." I said, "Yeah." It's like, I just need something down and dirty and simple that I can look at. I'm not getting into trading. I just want to know when should I be concerned to maybe switch because he does, even as a passive guy, he switches his portfolio over to something much, much more moderate. I was like, here you go. And it's basically that research piece. And without knowing it, something that dumb and simple, he has changed his approach to being basically it's a heuristically dynamic portfolio adjustment. So we're going to get all fancy and talk about it in the quantitative world. But just that simple piece. And he doesn't have to worry about this whole spiral of time starting, which can happen. Oh, no, it won't happen. Okay, well, I'll tell you what. Keep with your normalcy bias. You just keep with that. I don't like to have normalcy bias. Okay? So, just because remember, those drawdown periods do happen. Like you look at, well, that's sort of the max example, right? 1929, I think it was to 1954. But you look at something that happened during my trading career, 2000 to 2013. That's 13 years. 13 years. 1966 to 1978. That's what, 12 years? These things happen, folks. So, that research piece, right? We said, what do you do to avoid normalcy bias or a slowness to react? Well, you already know what to do. You know, in the military, Jocko says you train and you just drill. Well, in the quantitative financial world, you basically think about that scenario and think, how can I avoid it? Let me look what it looks like in research. Let me make the history that I'm doing this, when I do this research, even worse than what actually happened and see what would have happened then. Let me increase the slippage ratios and the noise ratios and everything else and see what it would look like then. Then you sort of know what you would do. And that simple research piece, right? Now, we were saying this. There's still going to be some drawdown even with that research piece. And I do think in that article we touch on that. Let me circle back to something I said we're going to come back to. And I said, you have your money in 3 or 4 different places. This is a quantitative principle that over at our other company, GTC Traders, we pride ourselves on. And by the way, I'm just going to say it. I have never heard this on other podcasts. Anybody can correct me if I'm wrong. More than willing to be proven wrong. But I just think it's way too easy to do podcasts now without the expertise. It's just way, way, way too easy. I mean, maybe somebody on Lots or somebody like that is talking about it. But even on more developed podcasts where you would expect more experienced guests, I'm hearing things like, well, just dollar cost the average and nobody can beat that. And it's like, oh my Lord. I feel like Billy Bob Thornton's character on Landman when he's like arguing with the oil energy commentator on the radio. My wife looked at me when we were watching Landman. She's like, oh my God, it sounds like you. It sounds like you arguing with, any financial news media. So even out of developed podcasts where you would expect the guests to have more of an education, I'm just sitting there going, well, this is just stupid, and it's verifiably false. Verifiably false. Look at that. Dan got inside another tangent. But anyway, so yes, first that research piece. And then what did I say? You might want to think about having your money in 3 or 4 different places doing different things. Well, why is that? There is a quantitative principle called the non-correlation of strategy thesis and non-correlation of returns of different programs that you'd be running. Well, that sounds all complicated, and I don't want to be an active trader. I'm not telling you to be an active trader. I'm actually sort of giving passive investors a lot of good stuff here. I'm talking about this manager specializes in XYZ. This manager over here specializes the second guy, right? So the first guy, he's delta neutral, but that's options, so I don't really want to have a lot there, really. I really don't. But it's sort of good, so that's 10% of my money. I'm going to put, because I'm young, I'm going to put like 60% of my money to this manager or this mutual fund, like VIGRX, that is just balls to the wall long, right? Now you got your money in 2 different places. 60, what do we say? 60 and 10%, we're up to 70%. And then I'm going to give, 25% of it over to this particular manager or this particular program, and it doesn't have dips, but it doesn't have any sort of like big upside, and it's in commodities. And all it worries about is it's just a commodity fund. Okay, I'm going to give that, I don't know, what did we say was left? We said 30% was left or something like, we'll give that 20%. And then you find 10% something else that's something completely different. And here's what you're going to find out. And this is like trading course stuff that I'm just giving you. Those periods of drawdown where your portfolio moves against you, they get smoothed out. They get smoothed out. This is something that you're just DCA the index, dude. It's just a 60-40, stocks and bonds, man. I don't hear any of them talking about that. So I'm telling you. If you don't believe me, go look up on YouTube Ray Dalio and the Holy Grail of investing and trading. And he's talking to active traders there about the non-correlation of strategy thesis and how many programs you want to run and variability of returns and things. You don't have to get that complicated. Look at the base principle, right? There should be time periods where as we said in that quantitative educational research piece, that you want to be flat. And that's so proven as to how powerful that is. And B, get your money in like 4 different places with I don't know if it's managers, I don't know if it's mutual funds or something doing different things. And what you'll find out is your returns are smoother. You start, on the beast programs where the guys balls to the long equities, but you know when to get flat out of that. Your returns are going to be like more impressive and can be more impressive than the S&P 500 index and more impressive on a risk-adjusted basis. So I don't care if you're talking about the volatility of your returns or just the alpha. Both. I'm dropping you folks pearls here. Pearls. I'm telling you. You're not hearing this stuff elsewhere. Okay? And you do this and you look at that research piece and you go look at that video by Ray Dalio and you start doing a little reading on your own. You're going to realize something. I can remain a passive investor if I want to be a passive investor. To which I say, more power to you, go with God. As I said before. But just thinking about this, just that first piece and this second thing that guy Dan mentioned, I wonder what that would look like back in history. Maybe I want to test that for myself just by hand. Just scratch it out and see what it would look like. Maybe I want to have my money in 4 different places, not just equities and bonds. Doing 4 different things as far as market returns. Okay? Free help for passive investors. Free help. Just gave it to you. Okay? So, we hope that has helped, and that should help fight against normalcy bias. At any point in time, I equally believe the market's going to continue to rally, and I've got programs doing that, and I believe the market's going to completely fall apart, and I've got programs doing that. And I've got carry trades going on at the moment, actually. I've got carry neutrals. Actually, one of my best programs right now is a carry neutral short strategy because I do personally, just here at the end of this podcast, I don't believe in this market rally at all. I have never seen a bigger disconnect between geopolitical risk, between risk markets, between the yield curve, and the Federal Reserve. I don't know if I've ever seen more of a Jackson Pollock painting of just wild disconnect between those factors as I do right now. So one of the programs I'm running is I don't believe in these valuations of where they're at in equities at the moment. They're just too stretched. Every institutional player I know, guys that work at really big firms, that I listen to or have had some minor interaction with, all of them are doing what I'm doing. Because my conclusion, I talk to them, is like, okay, well, now I don't feel like a big dummy. Is to have, if you can have some sort of neutral carry position that's giving you basis points, lean heavy into that, which is what we're doing at GTC Traders. Lean heavy into that and leave a little bit for trades that you see that are just like gimmies. Like, how could I not take this? I have to take this. And the neutral carry sort of floats us on through because things are looking nuts, like beyond nuts at the moment. All right. So that's our thoughts and what really passive investors, if you want to call yourselves that, could do to fight against normalcy bias, to where it's like, yeah, that can happen. And I'm not going to bury my head in the sand and I'm not going to go, oh, rainbows and unicorns and sunshine is just going to exist forever, right? Nah, I know what I would do. I've looked at it. I've, to borrow Jocko's term, I've trained for it. For those of you that are this far into the podcast, I train jiu-jitsu now, right? I have drilled that stupid thing, that stupid move, that rep 1,000 times for 4 weeks. I know what I would do, right? It's the same thing here. Oh, this is happening in markets and I'm seeing these prices. I already know what I'm going to do. That will fight, as Jocko says, train, right? In financial markets, I've already done the research. I know what I would do. I like that research piece, that quantitative educational research piece that GTC traders put out. And when I looked into this idea of non-correlation of strategy, thesis, and managers and assets, I like that. So here's what I'm going to do. And I've sort of done my own research, my own due diligence, and I like that idea, and that's what I'm going to do. And go with God. Be a passive investor. More power to you. I've made it that much harder for guys like me to beat you. Okay? So, I hope that's helped. I hope that has helped for whatever the heck day this is. Let's switch over just a little bit. We're going to do a little bit of housekeeping. Okay, so a little bit of housekeeping as we finish up this podcast. Now, this podcast is still finding a home, as you might know. It's been a long time since the last podcast, hasn't it? It sort of has. We're going to try and make them more regular, but running a single-family office structure is quite involved, let me tell you. So, we're going to try and have these out more, and I think I've got a home figured out for hosting and how we're going to expand hosting so that you'll be able to get this podcast everywhere. So that's first of all. And I'm having to write this down as I say this just so that I don't forget and I actually get it done on the to-do list. As well, some listen to this podcast, which is like a trader's light, we've called it, podcast. Financial trader gives just his thoughts, his own individual thoughts. Some folks like to be active traders, though, and that's why they listen. And so we have a separate company for coaching and mentoring using quantitative concepts, new and aspiring traders who are looking to improve their game. And that brand is called GTC Traders. We write articles. We have a YouTube page, the whole 9 yards. Subscribe, like, and sign up, right? There's a premium sort of coaching thing. It's only $15 a month, and you get that more just from the dividends, much less the fact I think we've had one losing month in the last 13, 14 months, something like that, 15 months. And we're playing a very knit game, by the way, at the moment. We're not going for huge explosive gains in this environment for the aforementioned reasons. We've got research pieces for premium members, There's a lot there. So that's GTC Traders. It's got its own podcast, which is going to be more prolific in the near future with podcasts. So check it out. If you're looking into coaching or mentoring for your trading game, GTC Traders, gtctraders.com. We're on YouTube. You should be able to find us pretty easily. Okay, and that has been this podcast. The sunshine and rainbows and unicorns normalcy trap. But as always, this has been what it always is. It's only been our thoughts. Actually, not our thoughts. Our thoughts is GTC Traders. This has just been me, just a single guy, just been my thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost a dime.
My friend, I long to see you on the other side. I long to see you on the